This is Business Morning.
All right, to talk more on commodities, we're being joined by Mr. Bismarck Rewane, the CEO of Financial Derivatives Company. Thank you very much for joining us. Good morning, Mr. Rewane.
Great to have you.
Well, OPEC Plus has called off its meeting without reaching a deal. What do you make of this, what we call it, continued loggerhead between Saudi Arabia and UAE?
Yeah.
First and foremost, you have to understand market structure. What you have is an oligopoly, which is few suppliers and many buyers. Because of the pandemic and even pre-pandemic, there was already some tussle between the major suppliers. Now, in a cartel, you have what they call a price leader and price follower. As far as we know it, Saudi Arabia has been a price leader for many years. So, but then when the markets got into balance, Saudi Arabia now reached out to Russia. So you now have OPEC Plus and Russia. So with those two countries, they're able to control principally the major supply in the markets. Now, what has happened is that as we get back to balance, then other smaller players begin to throw their weight around to actually establish their own leadership role. So what has happened is that the UAE is now saying that we need to establish our position as a major supplier and as a price leader. And that the cutback, in all, the cutback was about 9.7 million barrels, but they have actually restored about 4.7, right? And now there's about 5 million barrels left to put in. So UAE is saying that we need a bigger share of this 5 million barrels, and we want it now. The OPEC Plus is saying we would release 500,000 barrels a day every month from now till 2022, so that they don't rock the market. Well, Saudi Arabia says, we have nothing to, UAE says we have nothing to lose, and so that's the deadlock. The truth is that, in the end, in a price war, nobody wins. So I suspect that within the next 4 weeks or 2 weeks, they'll come up with some kind of agreement. Don't forget, at $77 a barrel, even shale oil becomes profitable, right? And so supply begins to kick in. But the UAE makes a point that with renewable energy and all sorts of attempts to liquid hydrogen and solar energy, the obsolescence of oil is a reality. And the growing irrelevance of OPEC is a function of time. So make hay whilst the sun shines, because the oil in the ground will not be as valuable, right, in a few years' time than what it is today. So that's the key issue.
But if this stalemate, continues, what happens to output in the future?
Well, the point is that at what point, who cares about output if nobody's going to be buying the oil a few years' time? Don't forget, electric vehicles, Tesla, and all these other guys are making, even now, there are aircraft now which are using liquid hydrogen, right? And even the space shuttles are using this kind of thing. So what UAE is saying is that, look, I want my money today. In any case, the money today is more valuable than money in future because of inflation. So, but that is not to write off oil. The truth is that every oil-producing country, including, especially countries like Nigeria, have to be, one, maximize the revenue and optimize the use of the revenue. If you waste it, then there'll be nothing left. Especially when you have
we're seeing, we saw oil inch closer to, $80. And of course, I know that a lot of people are calling for $100. I don't know if you see that happening. And if that happens, having a longer, higher oil price, what will be the implication for,
Nigeria?
Yes, both Nigeria oil importers and exporters, of course.
Well, let me take it back. The reality is that today, at $77 a barrel, we are almost 100% above the benchmark price, and we are about almost 30% higher than what it was about 3-4 months ago. So technically speaking, oil-producing countries should be clicking the champagne glasses, right? But for some who had structural problems,
like
right?
Nigeria.
Right? The oil revenue only masks the problem. The problem will still emerge. So you've got to deal with that. And then you have to come to terms with the fact that what are you doing with the oil? Because after a while, and a short while for that matter, you will not have that revenue to utilize. So you can see countries like Kuwait, Saudi Arabia already invested and planned for that day when there's no more oil. For some who are more reckless, then when that day comes, you'll be considered one of the former rich men.
So what does this mean for, inflationary pressure and, of course, global economic recovery?
Well, let's take a step back and say for the global recovery, I don't have a problem because the U.S., which is the world's largest economy, is projected to grow by almost 7% this year, based on base year effects of last year. China is going to grow maybe at about almost 6%. Even the European Union, the laggards, are going to grow about 2%. Nigeria, with some luck, will grow maybe about 1.5 to 2% if things, we don't have a third wave or something like that. Now, but growth is one thing, but sustainable and inclusive growth, which means employs people and reduces the amount of tension in the country, is another thing. So relating it to a question on inflation, we have seen inflation, consumer price inflation, according to the official data, actually decline marginally. But we have a different view because by this time last year, the country was in lockdown. By this time last year, there was no interstate movement. By this time last year, the airports were shut, only, no international flights. Therefore, if you were comparing the price of a basket of goods last year when the markets were shut, and this year, you would not be, the base year numbers may not be reliable. In other words, how could you have gone to a market to go and ask people what their prices were when the market was not open? So we question and we raised eyebrows and doubts about what the data of last year was. Having said that, the truth is that if you look at month-on-month inflation in Nigeria, according to MBS, it's actually increasing. So we have month-on-month inflation increasing, we have core inflation increasing. And then when we look at the narrow basket, you begin to see, for example, we took 5 products. The only one that stayed flat in the last 4 years was Coca-Cola, because it went from 100 naira to 150 naira. It went up by 50%. Rice came down marginally, but all other products, flour has gone up 28.35%, maize has gone up by almost 20%, Coca-Cola, in fact, I was wrong, has gone up by 50%. It was 100 naira 2019, it was 100 naira a bottle in 2020, it's now 150 naira. Cement, of course, has gone up to 4,000 naira.
Yeah.
So when you look at that, you find that 27.72% was the growth in prices, increase in prices in 2019 to 2020. And this year, we are seeing it go much higher, up to by 33%. So the jury is out. I think by the time the data comes out, we'll begin to see this on.
And your projection here shows you took a couple of locations, and it showed that you're projecting 18.1%.
Yes, we are projecting 18.1%, but it's a narrow...
But one would ask why. I mean, when we're having the MBS inflation data, declining, so what makes your data different? From...
No, MBS is looking at the entire nation. We are looking at Lagos. So it's a narrow market and a narrow sample. So it only points to the fact that within the Lagos metropolis, we are seeing higher prices, maybe in some other parts of the country. But the question you ask, what's driving this? The exchange rate depreciation did not take place until May 24, so the effect of that will only be felt in June. The price of petrol has remained relatively stable, right? And that also has a trigger. But price of diesel, as of today, is at 295 naira a liter, while the price of petrol is 165 naira a liter. Typically, in normal markets, petrol is more expensive than diesel, but diesel is fully deregulated while petrol is subsidized. So those are some of those distortions that will be corrected as we go along.
Yeah. Now, in an inflationary environment, of course, some make money and some lose money. So how would you say the fast-moving consumer goods companies have fared in this inflationary environment?
Okay. Very good question, because the reality is that when you face a price increase as a consumer, 2 things happen to you. One, because inflation is a thief of income, you have what we call the income effect. it means the amount of money available to you to spend has reduced. The immediate thing you deal with is substitution. So if you are eating cheese, maybe you take butter. If you are drinking coffee, maybe you take tea. And if you're drinking beer, maybe you drink Coca-Cola or something like that. So, but no, they're not substitutes, but, you know. Now, the reality is that consumers are beginning to switch as they get squeezed, right? Now, what fast-moving consumer goods companies have been doing, they have been looking for cost efficiencies and absorbing some of the price increase and passing on the rest to the consumers. Those who cannot do it have actually suffered. So, and that brings you to the fact that if you look at all of these companies, Dangote Cement, Unilever, Cadbury, Nestle, Flour Mills of Nigeria, most of them have actually thrived in this period, even though, because they've pushed prices up marginally, but also they've been able to absorb some of this. So now, if you look at them, you now look at a company like Flour Mills of Nigeria, which is quite interesting. Flour Mills of Nigeria are doing about 3 things at the same time. Number one, they are hunkering down. They are the dominant player in the flour milling business. 2 is that they are integrating backwards into feed milling, right? They have Premier Feeds, and they are pelletizing feed. So you actually have feed made in mash form, and you have feed made in pellets. Pelletization is very expensive, but it gives the protein, the chicken, the turkeys, and all that full benefit of the feed that is being put in. And it also reduces the disease factor. Not only that, they've actually, Flour Mills of Nigeria have gone backwards doing the Anchor program, trying to encourage Nigerian wheat growers. Although the wheat grown in Nigeria is of a completely different quality and fiber than the wheat that is imported, because for the wheat we used to make our bread, the Argentinian wheat, hard red winter wheat, Canadian wheat, and then, of course, US and Russian wheat. Because the taste of bread here is totally different from the taste of bread in other places. And that we've configured that over the years. So they've done well in the extent that they've gone also into irrigation, trying to ensure that we deal with some of the problems of growing agricultural products. What has it led to? It has led to a fact that they've seen their revenue increase by 34%. That is from 573 billion to 771 billion. They've seen their cost of sales have gone up by 31%. Their net profit has gone up from 11 billion to by 125% to 25.7 billion, right? And their free cash flow has actually increased by almost by a significant amount. Year to date, the stock has gained about 13%. So, and the reason why we are talking about Flour Mills is because they are the only company that has released their second quarter earnings so far. Others will, but one can expect that companies like Dangote Cement, companies like Nestle, and companies like MTN are also going to be coming forward with stellar results. So what it means is that in a difficult environment, an inflation environment, the strong get stronger, the rich get richer.
And the poor gets poorer.
I didn't say that, you said it.
The poor gets poorer.
All right,
yeah.
let's look at the second half of the year. What's your macroeconomic outlook, for the rest of the year?
Well, let me put it this way. These are difficult times, and trying to make projections is a treacherous business. But I'll guess 2 things. One, the reality is that we are going to grow. The second quarter growth numbers that are going to come out will be much stronger than second quarter of last year, because last year we had a contraction of minus 6.3%. So if you've fallen so low, to rise is not difficult. So it is what actually happens to the economy as a whole, and when will it create jobs and reduce insecurity. We are threatened by insecurity, we are threatened by inflation, we are threatened also by, we are on the fiscal cliff, that is, we are having a supplementary budget. Yeah. So generally speaking, I think that the economy will flatline and begin to grow towards the end of the year. We are going to be threatened by inflation. I think that the exchange rate mechanism that is being introduced, if the central bank can increase the supply of forex, will lead to some kind of some convergence, right? The exchange rate is a tricky one. But then we also have to deal with, you raised it initially, that if the price of oil is at $77 a barrel, then what happens if you have to remove the subsidies? And if you remove those subsidies, it means definitely that you could see the price of oil as high as maybe 280, 300 naira a liter.
PMS.
And how you deal with that is a major issue at this time.
Everything is going to go up.
Purchasing power will continue to drop. Anyway, thank you very much, Mr. Rewane, for your time.
Thank you for having me.
Always great to have you, sir. Thank you.
Okay, we take a break now. When we come back, we look at KPMG's CFO Outlook Survey. Tola Adeyemi, partner and head audit services, KPMG Nigeria, joins us next. To stay with us.